Hi, everyone. Thank you so much for joining us today. It is a pleasure to be hosting you. My name is Tara Spalding. I'm the managing director at Boom Startup Accelerator. I'd also like to introduce Christina Neld, and Christina is the new program analyst here at Boom Startup. Today, it's my pleasure to introduce Chris Badger. He's the CPA and partner of Now CFO. Today's OpenUp topic is very, very important for most startups to understand, which is revenue recognition for subscriptions. Before we dive into this topic, I'd like to go over a couple of rules. First off, this is set in meeting mode, so you can participate at any point of time, either by submitting a question in the chat or raising your hand. We do appreciate if you could keep yourself on mute unless we ask you to unmute because we didn't understand your question, and then you can speak up. We love to make this conversational as possible, and so please feel free to make notes and share your thoughts on what's interesting in the chat as well as questions. I'd like to give very special thanks to Now CFO, who is one of the premier sponsors of Boom Startup Accelerator. Now CFO provides financial visibility to make smarter decisions. This is extremely important, especially for early stage startups. Since you're a Boom Startup community member, Now CFO will provide you with 4 consulting hours to help you basically do what you need to do to improve your business. And the services can range from auditing to pro formas to just answering basic questions about revenue models as well as unit economics. Chris, our speaker, is going to explain a little bit more of that later, but this is a fantastic offering of our partnership. If you're new to Boom Startup Accelerator, I'd like to give you the first and warmest welcome possible. Boom Startup Accelerator is very unique and very different than other accelerators because we like to give an aha moment to every startup that participates within our community. What we do as an opt-in and online program is help you break through the barriers that are holding you or your business back. Through programs such as this, where we are communicating and educating you on what to expect, we also provide resources that range from mentors to tools, as well as services like what Now CFO provides to get you to succeed. And as you've probably noticed, our platform is tracking you not just during a specific amount of time like other companies or other accelerators do with cohorts. We're continuously tracking you, and we're making suggestions as to what you can pay attention next to grow your business. We envision that we have a multi-year relationship with you in an opt-in touch-based basis. And when the timing is right, we'll invite you into our investor community through our Amplify Up program. Boom Startup has a global startup community. We're really lucky to receive recipients from across the world. In fact, just a few weeks ago, we held our Pitch Up program, and we had over 200 founders submit from over 20 countries around the world. Boom Startup services companies within a variety of industries, as well as a variety of business models. And the reason why that we do this is because, one, financial acumen as well as capital planning is ubiquitous. And secondly, we're lucky to have a massive network of well trained and experienced mentors and experts that we can match and pair you up with so that you can learn from them and improve your business. How we measure success is by creating these learning opportunities and you having a positive experience and a positive takeaway that improves your business. And this can be about improving your revenue stream, learning more things about finances, or improving your go-to-market strategy. We also help companies set up for funding and make sure things such as your books are proper and that what you're doing is in fact on point or more advanced than what is going on in the market. We also vouch for your authenticity because every time you participate in a program like this or meet with our mentor, we track these sorts of behaviors, which help us identify that in fact you are ambitious and you are making improvements and plans to change. And we help a subset achieve their first round of up to $100,000 through our Amplify Up program. How we deliver success, as mentioned before, is very funding oriented. And our investment rounds are in fact unique compared to other accelerators because they are open. And we're permitted to do this because of the SPV vehicles, which our parent company, Assure, provides. Boom Startup programs are in 4 main cadres. This is an OpenUp, a workshop, online and available not only in live, but also on demand. We also have Rise Up programs, or intensive online 1-week programs that really dive into a specific business problem and not only connects you with the experts and others that are experiencing the problem, but also a plan of change that is expert approved. Pitch Up is our pitch competition, which I mentioned earlier. And also Amplify Up is our funding program where we leverage SPVs and our angel investor network to basically back your company when you're ready for investment. Now, with no further ado, I'm really excited to introduce you to Chris Badger. He is a CPA and he is also a partner at Now CFO. I strongly recommend that you connect with Chris on LinkedIn because he's a great advocate and a wonderful resource at any time of day to contact. Chris, I'm going to hand it over to you now.
Awesome. Thank you, Tara. As Tara said, I'm a partner with Now CFO. And so a lot of people are like, what the heck is Now CFO? And so we're a professional accounting firm. We're not a CPA firm, even though I am a CPA. What we practice, though, is operational accounting, and that's helping companies in their day-to-day, week-to-week, month-to-month accounting. We also do a lot of projections and modeling and stuff like that versus a CPA firm that does tax returns and does auditing, okay? So we're a professional accounting firm, not a CPA firm. We're located across the US. I could say we're coast to coast now. Obviously, we still have a lot of room to grow. And I just found out this morning that we've opened up offices in Albuquerque and in Ohio. So we're moving forward. We're very entrepreneurial, and we want to grow to be a nationwide firm and perhaps international as we go through. Go ahead and move the slide. So at Now CFO, some people say, well, what do you guys work with? And it's like, we work with everybody you can think of. And so a couple of weeks ago, we were at a manufacturing conference for cost accounting. So we had really serious cost accounting folks and questions. And then next week, we're actually going to work for the Utah Not-for-Profit Association. We work with e-commerce companies, with SaaS software startups, software development, sales, real estate development, construction, and I even know how to say oil and gas. So we can do pretty much anything with any industry. Go ahead. As Tara said, I'm a partner here in Salt Lake. I spent a lot of time in Denver, across the mountains, and been back here in Utah for the last 5 years. I have a practice of 25 professionals here, and we provide both support for companies here in Utah and pretty much nationwide. We've actually just signed a deal yesterday in Chicago, and then one in San Diego last week.
Chris, if I can add, you've worked a lot with startups over the years. How many startups do you think you've worked with?
Probably probably over 100, because we've done coaching and mentoring with venturecapital.org and then Boom Startup. I used to have to go downtown and kick the transients out of the parking spot so I could get a place to park at the impact hub, which was a very interesting experience. And so, yeah, we love working with startups because they're going to be the developing, emerging companies.
Yeah.
If you want to be really bored, I used to teach CPA review courses. So those are a 4-hour class in accounting. So if you ever want to learn all the ins and outs of how you amortize discount for bonds and premium for bonds, I can bore you at length for that. So I did mostly financial reporting classes and then also regulations, which are the tax classes.
Well,
I'm also,
entrepreneurs do suffer from insomnia, so that's great.
it'll be very helpful.
Yeah.
Um, I also volunteer on the a board member for the SHRM, which is the HR professional association. I've got a MBA from Keller Graduate School and a BA in accounting from the University of Utah. So I always like to say I am very artistic as well as a numbers driven person. So I have a BA.
Back to the brain. That's awesome.
Let's go ahead and let's talk about financials and what it really means and why it's important to have clean books. And so I want you to think right now with clean books, I want you to think monthly financials every month, reconciliations for cash accounts, balance sheet accounts. You have accounting policies and procedures, which means you've actually written down, how am I going to recognize revenue? When do I pay bills? How do I process everything? So think very formal policies and procedures. When I say clean books, I'm also meaning accrual accounting. And here in the US, that's going to be GAAP accounting. And so GAAP accounting for your word of the day, vocabulary word of the day, is GAAP, and that's generally accepted accounting principles. So in the United States, GAAP is how you do accounting. Okay, it's generally accepted accounting principles. If you're international and joining us internationally, it's going to be under the IFRS standards, the International Foreign, not foreign, International Financial Reporting Standards, the IFRS. Okay. And so again, clean books, think timely, accurate, relevant financials. You have those every month. You have a clean set of books. Things are reconciled. We work with a lot of different companies, and one of the first things we start out in engagement is to see that if the company is caught up, let's take a look at your bank recs. Let's see if the cash is really reconciled. And let's take a look at what else you have hidden on the balance sheet, because if you can get the balance sheet cleaned up, it'll force your income statement to be correct. Okay.
And so the cash statements are really your bank statements, right?
Yes. Yeah.
Okay.
Think bank statements and bank reconciliations within your accounting system. And when we talk about GAAP accounting, accrual accounting versus cash accounting, so I tell startups and companies, hey, when you want to put on your big boy pants and your big girl dress or big girl pants now, you know what? You're going to have to do accrual accounting, GAAP accounting. Cash is okay to start out, right? Everybody's got to start somewhere. But when you really want to grow up, and if you really want to be somebody, you're going to have to pull on your big boy pants, your big girl pants, and start doing your accrual accounting. And again, in the US, that's GAAP accounting. Okay. Publicly traded companies do accrual accounting. Mom and pop Main Street businesses, which are great, those are cash basis. Okay. So when you see cash accounting, cash basis accounting, think mom and pop Main Street type businesses, and that's usually for tax purposes. Okay. For growing companies, go ahead, Tara.
When would be a turn point? I think this is what you're about to say about growing companies, that you need to start converting from the cash basis where you're running on the like QuickBooks from your bank
Mhm.
to an accrual basis. What are some triggers that startups should pay attention to know this is approaching?
Mhm. So think of it, if you've got over 100,000 in income, so if you've got over 100,000 in revenue, that's time when you need to be thinking, okay, maybe it's been cashed up to this point, haven't invested a lot of time and effort into them. At this point, I'm going to be a growing company and I'm
Mhm.
100,000 now, but I want to be 1 million, right?
Okay.
And when that growth mode, you're going to need to start putting things into place and setting things up to where you're doing that accrual accounting setup. So that I look at, if you're below 100,000, hey, I know you're scraping to keep by, you're bootstrapping everything you can. But when you hit kind of that first milestone, which for a lot of companies, I use that as 100,000 in revenue, because that's not everybody. There's a lot of companies that never get to that point. But when you can get to 100,000, think of that as that first stepping stone and start putting into place how you're going to convert from cash to accrual.
Perfect. And then let's talk about the subscription tax implications.
Yeah. So on a subscription tax basis, remember a lot of early stage companies want to take advantage of cash basis accounting for tax purposes. Okay. Because whatever you pay out, you want to be able to take a deduction for. Okay. And small businesses, you might play games with what you pay this year versus next year because cash basis is very straightforward. So think cash in is revenue and cash out is expenses. Cash in, cash out. When you go to with a subscription base and start going to more of an accrual basis, you're going to have to recognize revenue as you earn it, not when you receive cash, right? The cash is irrelevant with that recognition. It's
Okay.
when you earn it because you're going to have to provide the services for it. So again, most small startups are going to be, at least in the US, an LLC partnership or S Corp and have flow through tax implications to the owners. And if you want to take advantage of those, that's great as you start up. Sooner or later, you might have to convert to a C Corp in order to raise money. A lot of investors want to see the C Corp because they don't like those pass-through tax implications. The other thing you might need to take a look at, and it's changing in every state, state by state, so is the dreaded sales tax, right?
Mhm.
So 20 years ago, sales tax was really easy. If you went into the store and you bought a physical good, if you bought a 12 pack of Mountain Dew, my favorite, you would have to pay sales tax on those physical goods as you took them out of the store. Well, a lot of states didn't have anything on the books for software services that you provide over the internet. And is that subject to sales tax? A lot of states, California, New York, Florida, and others that are having a lot of budgetary problems, guess what? They want to try to collect sales tax from everybody and anybody. And if you remember just a couple of years ago, Amazon gave up trying to fight sales tax issues, and every good that is sold through Amazon, they will collect sales tax on.
Now
You're gonna, yeah, go ahead.
let's talk about the tax and the tax auditing. Who usually does these sorts of, or what's at stake, and who typically gets audited?
So think of it as and this is just going to be a rule of thumb for states. If you have more than $100,000 of income in any state, they're going to tell you that you have economic nexus. And
Okay.
with that economic nexus, they're going to want to audit you and they're going to want to collect sales tax. Now, some states don't have, are not as aggressive as California, but everybody is kind of following California's lead and going after companies to pay in order to collect sales tax because they need revenue.
Got it.
And so think of that as kind of a rule of thumb. If you have business in any state where you're generating more than 100,000 of income, even if you don't have people there, even if you don't have any assets there, they're going to assign what they call economic nexus, and they're going to want to collect sales tax from you.
That's very
And
helpful.
yeah,
And let's go back to the clean books, because it also has the different paradigm that you put up here in the financial planning. If you wouldn't mind just giving a quick overview about that.
Yeah, think of all the financial planning you're using for the future and projections and modeling. Everything that you're doing is going to be pushed into accrual accounting. Okay. Think of that's the way you're going to run and manage your company, is using accrual accounting and using projections and planning next year's. So think of right now it's September. You should be putting together your next year annual budget, right?
Mhm.
And using those planning, and you're going to do that on an accrual basis because you want everything to match up with what you're doing and then what you're reporting to outsider investors.
Oh,
So
so it affects valuation. Can you explain that a little bit more?
yeah, so think with valuations, um, the basis for evaluation is going to be your basic financial statements.
Hmm.
And if you have them in an accrual basis format in GAAP accounting, you'll have strong valuations, right? If it's cash basis, valuation firms don't like those because now they're having to try to figure out, okay, if you're bunching up cash, when are you recognizing the revenue? And if you're trying to push out future streams of income and then discount them back, it's very difficult to do that with on a cash basis. And so
Okay.
they're going to want to see accrual basis financials.
And that's the GAAP compliance. Okay, Christina
Yep.
just raised her hand.
Yes, I'm so sorry, Raj. It looks like I missed your question. Do you mind unmuting and just directly asking it?
No worries at all. And Chris, thank you very much for the time. And you clarified it perfectly. Just no brick and mortar presence whatsoever, just pure sales. So, I mean, without setting up a foreign entity. Okay, thank you.
Yeah. So that it's the last. It's kind of funny. So if you want to be a tax legal tax expert in the sales tax area, the last really big court case that went before the Supreme Court was like in 1993. And that's how they use sales tax for the next 30 years. 4 years ago, the Wayfair Act went through the Supreme Court, and that really changed the playing ground. And that's when a lot of these states started going after that economic nexus. And so it's really only in the past few years where they've done that, and those states are being very aggressive with that.
So sales locations or buyers locations are really important. And it's ironic because this is also what happens with investors, because they too have to pay what's called blue sky fees.
Mm-hmm.
And that varies state by state as well. So having that sort of financial acumen, where your money is coming from, if you're investing, or where your money is coming from your customers, are very important.
Yeah.
Moving on to investor implications, we just talked about valuations. You were telling me a story, and I'd love for you to share it with everybody, about being responsive to your investors when they have financial questions. Chris, you've got to tell the gossip on this.
So think about it. If an investor is going to come in and wants to write a big check for money, right, they're going to want to see the financials, and they want to see timely, accurate financials. And so a few years ago, I was working at a very large mattress manufacturing company in northern Utah County. And on a Wednesday afternoon, everybody was running around whispering because Steve Young, the all-pro quarterback from the 49ers, was in the offices, and they were looking at doing a very large investment. Like this is $100 million investment. And it was, everybody's kind of running around. Everybody wants to see him. We had to make announcements, you don't go ask for his autograph. And his private equity firm, HGGC, was ready to do a deal, right? That was on Wednesday. And this was happening in late November. It was actually right after Thanksgiving. And what they wanted to be able to do is they knew that the revenue was growing tremendously through that year, but they wanted to see interim financials. And because the accounting department was in such, not shambles, but just way behind, we were also trying to implement an accounting system, going from QuickBooks to NetSuite, which was a jump. And here's a company that grew in revenue from about 20 million in revenue to over 100 million in a year, but we could not produce financials for September. So this is in November, and we couldn't provide accurate financials for September. And because of that, we had a $100 million deal walk off the table that week. And so, yes, having good, clean financials has a huge impact on investors, right? If you want to get an investor happy with what you're doing as a company, happy with where you are leading to and where your sales trajectory is going, having good, clean monthly financials every month is going to help you do that. Okay. If investors have to wait, they don't like to wait. And now they're going to start doubting and asking questions on everything. So get your house in order, get those monthly financials out.
Yeah, absolutely. And then moving on, subscription revenue models, very popular. Chris, I'm from the CRM space, and I remember Mark Benioff just killing it with the SaaS model, and that the subscription revenue model paired very well with also the delivery and the timing of the cash that they needed as well. Can you tell us a little bit more about the revenue model detail?
Yeah, so think of that subscription model. I'll give you a great example. I worked with a company in Denver, software development sales, and it was all to law firms and attorneys. Okay, it was a case management program. We would go into very large law firms. We'd make them pay $100,000 for the software, probably 50,000 to 70,000 for customizations. And then we'd try to get them to sign a maintenance agreement, right? And if they signed the maintenance agreement, then they got upgrades for free, right? And then we realized we had upgrades really every month. And so trying to get a law firm to do a $100,000 investment in software was really difficult, because all of those partners in the law firm, that was their vacation home, their boat, right? Their new Harley that they all want to get. And so it was really difficult for them to do that. And so our sales were always tough. We would try this and that. And back in 2008, we went to kind of a pre-runner of a SaaS. We went to an ASP model, an application service provider. We didn't have Amazon Web Services back then, so we had to go to a co-location, get things set up. And we went to a monthly fee. And on this monthly fee per user, it's sold like, hot pancakes, man. We, within a year of going to that type of model, so going from the old, software implementation, we're going to install it on your servers, here's 30 disks to install on your servers, to this ASP model in the cloud, we tripled revenue over that year, over 2008, and ended up getting bought out. And it was really because the users of the software, the attorneys, what they could do is they could stomach a monthly fee. What they couldn't stomach was $100,000 out of their pocket up front for software. And so that SaaS model, that kind of pay as you go, pay as you use it, that software as a service model is very, very popular now. And to be honest with you, I had one client that was still under the old model. And then this year they gave it up and said, we're going SaaS. So it's just the way it is nowadays. I haven't seen the old style software implementation for probably 5-6 years at least. And so companies are getting used to the monthly payments or an annual payment. And it's much more easier for companies to buy off on. Now, the one thing is, one of the items that a lot of companies like is it's a monthly payment. Usually companies will discount it if you pay it for it annually, but it's an easily payable monthly. Remember, for you guys as business owners, for a subscription business, revenue does not equal cash. Okay. Your subscription revenue is earned after you deliver those services. So think of it over time. So if you're getting paid for a year up front, that's great. You got cash in the bank. That's the way you want to do it. but you're going to recognize revenue for that payment over the year. Okay. And so think of it as 1/12, 1/12, 1/12. Each month, you're going to recognize 1/12 of that revenue. Okay. You know, these days you've got, subscriptions that, can be paid annually. I've seen a lot of 3-year one, 36 months one,
Sure. Yeah.
And this is very different than just recurring billing. Like going back to the example I gave with that practice management software for lawyers in Denver, we tried to do recurring billing annually, but it just never matched up, right? And so get that subscription in place, have a agreement, a contract in place. You bill monthly, you bill annually, bill every 3 years, and get that set up.
So one of the indicators that if you're doing the accrual right, just based on my personal experience, is if there's a cash in line and then there's the revenue line, correct? So you separate
Correct.
the two.
Yep.
So that's a really good first step right there. If you do receive a payment up front, put it in your cash in line, but then when it's actually the service or the solution has been delivered for that time period, then put it in your revenue line.
Yep. So
go ahead.
I was going to say, one of the other indicators is if you have deferred revenue on your balance sheet, and we'll talk a little bit more about deferred revenue, but as Tara said, you're going to debit cash. So your cash in and credit that deferred revenue. And then think of it as you're going to amortize it every month. There's some pretty sophisticated software systems out there like Avalara and others that will actually do it daily. That's pretty serious for startups. And so just realize that you're going to recognize revenue over time. Okay. As you provide those monthly services, that's when you are going to recognize the revenue. So it's a matching principle. So in accounting, as much as possible, you want to match up with the revenue and your expenses, right? So you're going to have the expenses of providing those services every month, and you're going to recognize the revenue of providing those services each month.
Now, subscriptions also have a different kind of contract altogether. As we said in this bullets, the components of subscriptions are different, such as like the duration, the termination,
Yep.
total and period fee, in different accelerators that can in fact bump up the cost. Can you explain about, these components and how they're important?
Yeah, so think with accelerators, that's one of the things you want to be tracking how many people or who's using your software, right? And that's something that you should be receiving revenue or should be receiving cash for. Mm-hmm. When you provide additional users, right, you should be charging more. You've got a total cost per month or per year for those users. Within your agreement, make sure you've got the duration. When is it good to, does it automatically renew? Okay. Automatic renewals are really popular, right? But you want to make sure that it's something that they can opt out with, right? So they have, depending on the state, some of the states do 60-day notices versus 30 days. So whatever you have in your agreement, make sure that it can be used pretty much throughout all the states, okay? And so you want to make sure things are very well written out, spelled out, and those are in your agreement, not said necessarily in the terms of use, okay? You want that in agreement that they're actually going to sign, right? Because now once they sign it, it's actually a contract. So that subscription agreement, once it's signed, is the contract that you're going to deliver services with, and then also collect fees. And
one other thing I'd love to add is that having these components as built-in triggers with whatever solution you have is very important. When I ran product development for a large software company, that we were tightly integrating the billing, acknowledgement of user and usage per each account and deployment, and that whole workflow automation is incredibly important to also pay attention to. But that's a different conversation. But I definitely want to mention that one of the components is integration, and that wasn't listed on this.
Yeah. So think also what I like with the subscription agreements, it really documents what you're providing, what you're servicing, and then also what you're going to be collecting. So if there's disputes or anything later, you've got plenty of documentation that you can go back and you can show which users were using what, who was on the software using the systems versus who was inactive.
Yep, good old log files. And then subscription refunds. This one's a hairy one, Chris. I know you have a lot of experience of trying to navigate this and keep it simple.
So one of the things you want to do is there's a difference. I want people to understand there's a difference between a refund and a bad debt. Okay. So a bad debt is when you bill somebody for something that they have either purchased or used and they owe you that money, right? So you're invoicing them. Okay. If you can't collect that invoice, then that's a bad debt, right? Because you earned that revenue, right? But now you're not able to collect it. So when you can't collect it, think bad debt. If you're going to give a refund out, you want to make sure that that goes against your revenue. So it's a contra revenue account, okay? Because what you don't want to do, which a lot of startups get caught up with, is what are they trying to do? We got to build up revenue, right? We got to get our revenue up. Well, you can't get your revenue up and then write it all off in bad debts, okay? If you're going to do refunds, make sure that they're in a contra revenue account and it's recorded as contra revenue, okay? So it will lower your revenue amount. And that's really because if you're refunding, you really haven't provided those services, right? You really didn't earn it. And so if you're giving a good customer service, or if you're trying to keep good customer relationships and you do a refund, just remember that goes against a contra revenue account, not bad debts. Okay.
Now let's drill into more of the accounting, because the contra revenue is really important. You mentioned earlier deferred revenue. Would you mind walking us through these really quickly?
Yeah. So deferred revenue is debit cash, and you're going to credit a liability on your balance sheet because you either have to earn it, and if you earn it, it's going to go from that liability account to your revenue account. If you don't earn it, what do you have to do? You're going to have to pay it back. So that's why it's a liability, because you may not earn it and you may have to send it back, right? Because you owe it back. So deferred revenue is a credit on the liability section of your balance sheet. If it's going to be earned in the next 12 months, you keep it in current liabilities. And for bonus points today, if it's a 3-year contract and it's not going to be earned until that second or third year, it actually goes into long-term liabilities, right? Anything over 12 months is long-term. Okay. So that deferred revenue, everybody loves it. They go, wow, you got all this deferred revenue. And it's a good thing because you've gotten cash for it. Okay. But deferred revenue is not cash. It's just revenue that you're going to recognize as you earn it over a period of time, whether it's over the next 12 months or over the next 3 years. Okay. So deferred revenue, that's kind of one of the indicators for a SaaS company, for a subscription-based company. On the balance sheet, you'll see that deferred revenue. And in good accounting, you're going to kind of think of it, you're going to reconcile that and clean it up every month. It's part of your monthly closeout cycle.
What's accrued then?
Yep. So accrued revenue, I want you to think you've earned it, but you haven't caught up with the billing yet. So you may have earned revenue. So for example, for myself and our business, we bill every 2 weeks, but this Friday, I have revenue that my people have earned over this last week with their hourly billing, but we haven't billed them yet, right? But as of Friday, there's going to be an amount of unearned, or it's earned revenue, but unbilled. Okay. And that's accrued revenue. Okay. Accrued revenue. Most companies want to be quickly billing. And so a lot of times you don't see that on companies' books. But if you haven't billed it out yet, it's accrued revenue.
No, I think you did a great job explaining cash and accrual basis. And for the sake of time, let's skip that. But ASC 606, can you explain that?
So I love that. Tara actually said accounting standards codification. And so ASC, when you see that, that's like the Bible for accountants. So the codification is bringing together all the different ways that could become, or all the different ways that information was generated to build up GAAP, remember generally accepted accounting principles, and they pulled that all into the codification. 5 years ago, they came out with this new ASC 606 and standardized the revenue recognition for most companies. And again, we've kind of talked about accrual, the ASC 606, the revenue recognition standards. It's not too complicated, but for most companies, think of it, you're going to need a revenue recognition memo to say, how are you recognizing revenue? How are you billing? So if you're billing on an annual basis for a prepaid, you're going to recognize that 1/12 every month as you provide those services. In your ASC 606 memo, if you do 3-year billing, so a 36-month billing, you'll also go into how you'd recognize that over the 36 months. Okay. So ASC 606 is really set up so that the revenue recognition would be more standardized amongst many different companies and industries. So whether you're construction or manufacturing or software development or SaaS company, the revenue recognition standards are codified to be very similar so that you can compare companies' revenue from industry to industry.
Chris, thank you so much for explaining the accounting background and diving in. The other great aspect that I think people will get excited about is understanding how what's happening on in the accruals really is the financial KPIs, especially around subscriptions. And they're kind of their own animal compared to other companies like that are transaction based, for example. Yeah. And so regardless of, you know, having a singular revenue stream or multiple revenue stream, you always need KPIs. But if you can dive into how subscription-based KPIs just really do help make sure, you know, your decisions and your plans are making sense.
Mm-hmm. So think of it with the key performance indicators, the KPIs. They're really how you're going to manage your businesses from a month-to-month, year-to-year basis. And especially with subscription companies, you're going to hear everybody's going to talk about ARR. Where are you right now with ARR? How much revenue with the contracts you have signed right now? How much annual recurring revenue do you have on the books? Most investors, that's going to be the first thing they're asking. And that's going to tell you the size of the company. Because if you can reach $1 million in annual recurring revenue with contracts you have in place right now, that's a huge milestone. That's great. But just think how much better it is when it's 10 million, right? And it just tells the investors kind of what's the size of the company and also what they have locked in, because they don't like with subscription-based companies, with SaaS type companies, you don't want to have a lot of churn or lost company or lost customers. You just want to see that ARR continue to grow, right? You don't want to lose clients. You just want to keep that growing. And so that annual recurring revenue is great. You'll see us.
If we can pause right there, because Chris, as you know, there's a lot of companies that start off with services or transactions and blend over to ARR. And so annual recurring revenue is like who's under those subscription contracts looking forward for the next year to get that amount. And then if you can compare that as a percentage to, for say, like services or transactions, et cetera, that too can help you out understand the health of your company and such, right?
Right. And so think about it as an investor, when they come in, when they see that annual recurring revenue, and they know that you've got at least $1 million in revenue over the next year, or you have at least 10 million in ARR, you've got that locked in, right? And then the services are kind of like the cherry on top or the icing on the cake.
Right.
Whereas that annual recurring revenue, that's kind of the standard that those investors are going to be looking at.
And usually services don't get the high multipliers and valuation just because they're not nearly as profitable as subscriptions, and we'll talk about that profit point in a bit. But, the more that you can put into recurring revenue or into your subscription, this really does help your company look appealing to investors in where you're not giving away the house for, a cash investment.
Yep. Services are very hard to get a high multiple. I know because I provide professional services, and for every increase in revenue, I've got to add another person, right? And there's a cost to that. And so my margin is not very large. Whereas on a SaaS company, a subscription-based company, that margin, that gross margin can be very large. And so that's what's really scalable. And services, investors, that's neat. And a lot of companies, you need to provide those to start out, but those aren't as readily scalable as the SaaS software is. Okay. I was going to say, make sure with those KPIs that you got your CAC. They're always going to want to know how much does it cost you to go out and get a new client, right? Some e-commerce companies have that down to a science, right? They've got all that data. If you're a subscription-based software, you still need to know, what does it cost you for every customer that you're acquiring? What does that really cost you on a monthly or annual basis? The other piece that investors always love is, once you get that client in the door, right? What's your lifetime value, right? Are you keeping them from year to year to year? Do they like your software? Because if you have a great set of software, but you've got 50% churn every year, you got 50% loss, that's not very appealing to investors, right? They want to see very low churn. They want to see the subscriptions stay up. And if you're in the 95% or above, you're going to be able to do some really good deals with investors. As it says there, the KPIs, investors are going to use that to compare companies, compare investments, right? And the better your KPIs, the more appealing you're going to be, right? And they're always going to start looking at, okay, well, what's the norm for this industry? What's the benchmark? What am I comparing it to? And are you above the benchmark, right? Are you doing better than everybody else, or are you way below? And
Chris, this is another reason why they need to work with experts such as yourself that sees a variety of companies, right? Like if I asked you, hey, Chris, what's the average, profit margin or percent of profit that a software company has compared to a manufacturing company? What would you say?
Oh, gross margin should be up in the 90 percentile versus manufacturing, maybe 40%, maybe 30%.
And so that's how come these KPIs of just having your financials standardized, and then talking to someone like Chris, in 15 seconds, you can figure out if you're running your company right or not, and you can just get that, gut check from people who see this stuff all the time.
Right. And it's one of those things too. Remember, you're kind of, you want to be very comparable with other companies. And if you're way outside the norm, then you got to have, what's the story there, or what's happening there. And, I worked with one company, and it was not a direct B2C, it was B2B. And they just could not keep their clients in. And so they had a lot of turnover, and that cost them when they went to do a transaction. Even though they had great software, they had great services, great company, they just weren't as appealing as other SaaS software companies that were able to keep their clients in.
And isn't this great? You guys, like, you can find this all out, not by using a CRM system, right? Not by talking to your sales team or even you counting, your customers, etc. You literally can figure out that you have a customer problem. If your customer acquisition cost is really high, then you can deduce that there's a churn problem, or a go-to-market strategy problem. It's all coming straight from the ledger, right? It's just really simple. So you don't have to invest in a ton of different tools to figure out if you're developing your startup, right? It's just really truing up your books, and you should be doing it at least once a month. At least once a month, of just reviewing your bank accounts and just realigning it with what you have on cash on hand, and like what's Chris was mentioning, what's deferred or accrued when it comes to revenue streams, and that is enough. That's a very healthy first step to see if like you're creating a viable business that's on the path to profitability.
Yep. I was going to say, one of the best things that our consultants can do is get the entrepreneurs, the business owners, to do a monthly P&L review, right? Review the KPIs, look at where you're trending to, and be able to have that soon enough in the month where you can make decisions in that month that are, they're accurate, because you're making business decisions with good data, with great business intelligence. If you're just guessing and you're going, every couple months, maybe doing a review, that's not very disciplined. Get yourself into that monthly habit of doing a P&L review, making sure you understand where you're at today, where you're trending to, where sales at, right? And if you're doing that past the 15th of the month, that's too late. So sometime between the 5th and the 15th, you should be doing that monthly, okay? Do that P&L review. Make sure you've got good, clean, accurate financials, timely. I always love it. I had a company, this is a very large grocery store chain in Utah and the Intermountain West. And they would close out each month a month and a half later. And so when you're looking at sales and revenue and expenses a month and a half later, you really can't make decisions to impact where you're at. Okay. It's almost too late at that time. So think timely, accurate, make business decisions using that information, and get into that monthly habit of the P&L reviews.
Okay, I think we have a question from one of our audience members. If you can please unmute and ask.
Hi, Chris. Thank you very much for such a nice, I think, detailed presentation. A quick question. We are basically a UK-based business now, recently started in Kentucky. And what we offer transportation for elderly disabled people within technology. So it's not like a pure Uber kind of business. We have a lot of human touch kind of thing in the whole relationship. So we offer the vehicle which is leased, not owned by us. The technology is training our core business. So in Kentucky, what we are doing, we are actually asking people to join our platform where we can give the technology and training so that we can do the revenue sharing like Uber. Somebody told me, if you're offering service, it is tax-free. You can exempt it from paying tax. But if you are selling those devices to the driver or the companies, you might be liable to pay tax. So I'm not sure which is right. If we can help you on that.
Yep. So think old style sales tax. It was always a physical good. It had to be something touchable, tangible, right? In a lot of the state laws, it's a tangible good that you are going to pay sales tax on. So if you're giving if you're selling devices to drivers, yes, that's going to be very easily taxable. For services, if you're providing an intangible asset to them, some states are going after that now for sales tax. Okay, some of the more aggressive ones like California, New York, where they need the sales tax revenue, they're going to go after you now for services. In a lot of states, and I don't know about Kentucky specifically, but a lot of states, services are exempted. And so for personal services for accounting services are not taxable. In Utah last year, when COVID first hit, in one of the sessions, the Utah legislator was looking at taxing professional services. So that would be attorneys, accountants, and other professional fees, professional services that are paid for by fee for either hourly or a set amount. They were looking at taxing those, and that did not pass, luckily. But every state's going to be a little bit different, and so you're going to need to take a look in the states. I can guarantee you, though, for a physical product that you're selling to those drivers, you're going to be subject to sales tax because you're selling it to them for their end use. For services, you're going to have to look at it on a state-by-state basis.
Right. Thank you, Chris. Thank you for the information.
We also have a question from Raj Mawad. Raj, if you can jump in, great to see you, by the way.
So thank you very much, Taryn. And again, Chris, thanks for the time. Won't get too detailed on pro formas for investors and whatnot. Let's just say we introduce a V2 or an iteration, let's say 14 months down the road, and that will change our revenue because our subscription might go up. Do you want to see that? Is it a line item that gets iterative? How detailed? How less? I mean, at what point are you like, okay, that's a lot?
Yeah, at the end of the day, it's a real projection. But what you want to be able to do to make sure that iteration is really understood is you start out with actuals, right? Mm-hmm. And then you've got monthlies, and then 14th month, you're going to change some assumptions and push out those differences, drive up revenue. If I can easily follow from actual what you're doing today, what's going to change in the 14 months, what's that assumption change? And then boom, I can see that drive the revenue, then that's going to be much more palatable or appealing to me if I'm an investor, right? Because you're starting out with what's actual, what's there, and then you're adjusting as you move on. So does that make sense, Raj?
Yeah, that makes perfect sense. I just wanted to know, I didn't want to give too much detail, even though we had our actuals and then we knew exactly when our burn to release our next thing, add some tech debt, but changes revenue. I just didn't know how nuanced to get on pro formas, to be honest.
Yeah, and I've seen pro formas with 64 different tabs. And
yeah, no, sorry, just no. I don't have that in me, Chris.
I know.
Okay.
And I've seen others that are one page, right? It's going to be, whatever you put together for that is going to be a reflection of you and your company. And so you want it to be able to withstand some kicking of the tires so that it's good and it's supported. But yeah, sometimes you can just go way, way overboard. I just like it when I can easily follow what's actually been done to what's going to be happening in those changes in the assumptions and the variables.
We have a couple more questions coming in, and y'all keep them coming through the chat. So let's just continue on. Thank you, Raj. If there's any follow-ups, certainly connect with Chris. Anthony Koltenuk asked if our primary customer is tax exempt, should we still anticipate aggressive states seeking proof of exemption?
Yes. I just did help with a client. So this is probably the most sexiest client you'll hear today. So he sells sewage pumps.
Woo!
And he's done it. His dad did it before him. That's right. He's been doing it since 93. He sells sewage pumps, right? And most of his sales are to cities and municipalities for, guess what? Sewage plants, right? And state of Colorado came after him for everything. And guess what? He had to go to counties within Colorado to get exemption certificates. And so it's just one of those things where because states are having such budgetary issues, problems, they're going to go after whoever they can, because the auditor in this case threw a huge penalty. They wanted over $30,000 in sales tax for 3 years. And it was just ridiculous because all of his clients, he sells he sells 20 pumps to cities and municipalities, and then 1 pump to and he tracks everything, and he does pay sales tax on the ones that are to builders.
Yeah.
But the state of Colorado, once they got the proof and the exemption certificates back down, but yeah, it's just the way it is.
Great answer. Anthony, if there's any follow-ups, please put it in the chat. Your next question, Chris, is from Nicole Homer. Great to see you, Nicole. Thank you for joining. Can you unmute yourself and
Sure.
ask about the accounting practices?
Yes, absolutely. Hi, everyone. I really appreciate this. Has been fantastic. My question, Chris, is the product that we are offering is a combination in that we are providing like an actual physical product that comes with a subscription model. So we would be charging for the product and then charging for each individual user who will have access to that product. So how would I capture that in our accounting books?
Depending on how sophisticated, if you're using QuickBooks, it's kind of separate invoices for each additional user. Or you're going to have a system that can track additional users or upfeeds. So I can tell you that if you're over a couple $1 million in revenue, then it's probably time to move to a system like Avalara that can track users, monthly fees, and those type of things. And so think of it as you'll set up your contract, you'll set up your original billing. Then if it changes or you've got more users or less users, it can adjust on a monthly basis.
Okay.
If you're on QuickBooks, I apologize, but you're gonna have to do it manually. Not an easy way.
I am on QuickBooks, so I can appreciate that empathy.
Yeah. And just so you know, I personally don't like QuickBooks, but guess what? I get my wife's business. Guess what? I get to do it on QuickBooks.
Yeah.
That's love. That's dedication.
Yeah.
Yeah.
But Nicole, back to what we were mentioning before, Chris said something very important. I did this as well at a previous company. Separate invoices are really helpful, more so than line items in a single invoice.
Okay.
When it comes to basically backtracking, especially with what sales is doing. So I agree with Chris on that aspect.
Okay.
Yeah.
All right. Thank you. I appreciate that.
And Nicole, you can also set up the revenue to go into different accounts to set up. So it's Tara is very correct. You want to be able to track individual invoices because it's going to be easier to go back and research. But you can also set up multiple different revenue lines or revenue streams. And so you can track both by going back to the invoice, and then you can also track monthly the revenue that is being built up by those invoices.
Per user. So we have, we would do the product on one invoice, and then if they wanted to have 10 users to access their data, that would be captured in the separate invoice, but the individual users would not be individually captured. So I wouldn't have 10 invoices, right? I would just have 9.
Right.
Or 2, right?
2.
Yeah.
Yep. As long as you want to track it back that way, and also 2 separate line items for revenue. So revenue for your the asset you're giving them, and then usage fees.
Gotcha. Okay. That's really good. Thank you.
You
No
guys,
problem.
these are wonderful questions. I encourage other people to pop them into the chat. I know we're a few minutes over. If you have to jump off, thank you so much for joining. But if you have questions, you can either unmute yourself or put it into the chat. But these questions are fantastic, and Chris is such a great resource. And as you're typing, just to kill a little bit of time, Chris and Boom Startup have come up with top accounting and financial KPI terms. Here are the first 10 terms. Well, there's 20 total. This is available to you, by the way. After this is all done and broadcasted, it'll be on the landing page for you to download for free. And, it goes into accrued revenue, active subscribers, auto renewal, another really big term, cancellation refund policies, churn, customer acquisition cost, deferred revenue, GAAP accounting, IFRS accounting, growth rate, invoice payments, lifetime value, outstanding accounts receivable. This too is really big. We didn't spend much time on this, but that's a huge one. Gross margin, net profit margin, and there is a very important difference there. Recognized revenue, retention or renewal rate, subscription limits, subscription payment, and subscription terms. So if you're running a SaaS company, you should know these terms for KPIs or for accounting. Just be comfortable with them. You don't have to be a pro, but just know what they mean and the nuances from there.
Yeah.
And go ahead, Chris.
And I was going to say what's easy for some of those that are the ratios, so lifetime value, gross margins, and all those stuff. Make those part of your monthly financial package so that you're tracking them on a monthly basis. Okay, because once you get your products in place, you're providing great services and software for your clients, those percentages, those KPI indicators should only get better, right? And if you're tracking them monthly, you can make adjustments, or it tells you where you need to investigate. So make sure that they're part of your monthly financials. Even though I love balance sheets and income statements more, KPIs are a great way to help run your business.
Well, Chris, thank you so much for your time today. I hope this was informative and helpful for everyone. Be on the lookout for an email at the end of the day with this recording and access to these top 20 terms for the download. Chris, thank you so much. Any last words?
No problem. We love being part of Boom Startup. It's one of the funner associations and organizations that we deal with, and we love Tara and Christina. Welcome aboard, and we're looking forward to seeing some of you and some of our other events that are happening, and want to wish you all a great rest of your afternoon, or if you're coming from overseas, have a great night.
Thank you all.
Thank you.